When you deposit money in a bank, you're not storing it in a vault with your name on it. You're technically making a loan to the bank that becomes their asset to lend out under regulatory oversight, though your deposits are typically protected by government insurance schemes. Number 1, you're just a creditor. Legally speaking, when you deposit money into a checking or savings account, you become an unsecured creditor of the bank. The money isn't yours anymore, it's the bank's. They owe you a debt equal to your deposit amount, but the actual cash belongs to them. This isn't some technicality, it's fundamental banking law that governs every transaction you make. Number 2, banks loan your money. But here's where it gets interesting. Banks don't just hold your money. When you make a deposit, they can legally lend out most of it to other customers, subject to reserve requirements set by central banks. Your deposit becomes part of their lending capital for mortgages, credit cards, and business loans. The exact percentage they can lend varies by country and regulations, but the principle remains. They're making money by using your deposits to generate interest income from loans. Number 3, the reality of bank reserves. Under fractional reserve banking, banks historically kept only a fraction of deposits as reserves, though the U.S. eliminated reserve requirements in 2020. While banks don't hold 100% of deposits as cash, your money is protected by deposit insurance, bank assets, and central bank backing systems that prevent the scenario described. Number 4, when banks actually fail. What nobody tells you is what happens when banks fail. The FDIC insures deposits up to $250,000 per depositor per bank. While the FDIC's reserve fund maintains about 1.35% of insured deposits, this doesn't mean coverage is limited. The FDIC has multiple funding sources, including the ability to borrow from the U.S. Treasury, assess fees on surviving banks, and issue debt backed by the full faith and credit of the U.S. government. In practice, no depositor has ever lost money on insured deposits. Number 5, civil asset forfeiture laws. Civil asset forfeiture allows law enforcement to seize property, including bank accounts, suspected of being connected to criminal activity. However, this process requires judicial oversight and must meet a probable cause standard, not mere suspicion. While the burden of proof in civil cases is lower than criminal cases, property owners have due process rights to challenge seizures in court. Recent reforms in many states have strengthened protections and raised the burden of proof required for seizures. Number 6, Cyprus changed the rules. The rules changed forever in 2013 when Cyprus implemented the first bail-in during their banking crisis. Instead of taxpayers bailing out failed banks, depositors with more than 100,000 euros lost approximately 80 to 90% of their savings to recapitalize the banks. This precedent is now written into banking regulations. Number 7, understanding modern banking reality. Your bank account represents a claim on a fractional reserve institution that lends out most deposits while maintaining reserves. Banks operate under government regulation and oversight. Deposits up to insurance limits are protected, though civil forfeiture laws do exist. In extreme cases, some jurisdictions have bail-in mechanisms that may affect large uninsured deposits, but these don't typically apply to regular consumer accounts within insurance coverage. The next time you check your balance, remember, you're looking at debt owed to you, not money you own. If this opened your eyes to how banking really works, subscribe for more shocking money truths.